Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon and Yellow Tunnel. And today we're going to have a strategy roundtable discussion where we talk about current market conditions. Any questions you might have about Tradespoon or Yellow Tunnel subscriptions and how to trade in current market environment. For those of you who are new, welcome. If this is your first live event, do me a favor, just type in first. Always want to welcome new subscribers. This is my brief bio. I was Executive Vice President and Head of Technology at Options Express from its inception through 2007. Options Express was an online broker-dealer acquired by Charles Schwab in 2011. I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing that for over 15 years, mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in technology and science. Disclosures are very important. Trading stock and options involve risk and not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered as FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, it should not be assumed that the future trade picks will be profitable or will equal past performance. And you can see the relationship between Tradespoon and Trading Block on the bottom of my screen. All right, in terms of trading system, before we jump into a trading system, let's talk about current market conditions. So this is probably what everybody is thinking about. I'm looking at the spiders. Let's look at the one-day chart. So one-day chart, we're sitting right at this key support. We've tested 330. So I think 330 is now the important support line, and the market has been trading for the past almost 2 weeks near the 50-day moving average. So we have a dichotomy. On one hand, we have technology sector that's already broke through the 50-day moving average. So technology sector is leading the market correction. It's already sold off from 303 to 266 levels. So that's about what, 37 points, maybe 12%, right? So 12% correction, which is a healthy correction, but again, retesting key support level at 265, right? Below the 265 level, the next level of support in technology is 250. So the question is on everybody's mind, is this, first, the most important question, is this a short-term correction, 10, 15%, 16% correction in the technology sector, maybe 5 to 10% correction in spiders? Is this a short-term correction, or is this kind of a change in trend, and now instead of being a bull market, we're going to trade in some kind of a consolidated range, or potentially enter a bear market? My personal opinion that this is a short-term correction, which is a healthy correction after a historical sell-off and then historical rally in terms of the magnitude and the time it took to sell off and recover. So my personal opinion, this is a short-term correction. I think this level in spiders will hold 330. Next week, September is usually volatile, so when I say the 330 level will hold, potentially, looking at the ABC pattern, and the support level, potentially market can overshoot to the downside, right? I think it could be a brief washout next week where volatility is going to rise, and we can retest 326, worst case scenario 322 level. So I personally think that there is a high probability that we will retest 327 level. Worst case scenario, when we have these washout days, when VIX jumps to 40 level or maybe even 50 level, the worst case scenario is 320. But I think this is going to be a short-term correction. And either the end of September, how much time do we have? So we have 2 more weeks in September. So either the following week or the first 2 weeks of October, the bull market will resume. So that's kind of my anticipation. Again, the pressure will come from the growth stocks, whether it's QQQ, Amazons of the world. Amazon is kind of in free fall, approaching the key support level at 2,900. I would watch the 2,900 level. This is a 2 standard deviation move, so it happens only 5% of the time based on historical volatility. So pretty significant sell-off in Amazon, Apple. Apple is trading below 50-day moving average. PayPal. So growth stocks are and technology stocks are under pressure. Facebook, I think last time I checked, below 50-day moving average, approaching support. So the pressure will come from the technology sector, I think, and value stocks, whether it's Dow Jones or just value stocks in general, are sitting at the key support level, right? Dow Jones is trading above 50-day moving average, outperforming the market, and value stocks in general, kind of similar price pattern, are staying above 50-day moving average, staying above 200-day moving average. That's where the support coming from. Stocks like Nucor continues to go higher. So industrials, Steel Dynamics, home builders, materials in general provide support to the market. We have rally in metals and miners. FCX. So this is the reason why I think this is more of a sector rotation, where more and more market participants believe in the V-shaped economic recovery, right? We have V-shaped stock market recovery, and now more market participants believe that we're going to have a V-shaped recovery in industrials, constructions, manufacturing, and such. So that's my reason. Two things that also very important to keep in mind is Treasury. Treasury are trading in sideways range, so there's no evidence of dislocation or panic in the market. So money usually flowed from Treasury market. If the people are selling their treasuries, then the money will go into equity. That's the usual consensus, and the currencies. Dollar spiked yesterday. This is a key overhead resistance, 94. We've been trading on this level for the past 2 months, right? Dollars trading in the sideways range, and the trend is, obviously the trend is to the downside, and I think the consensus is that the dollar is going to continue to be weaker. As long as the dollar is continue to be the weaker, that's another bull's case. So the bull's case is Treasury market, currency market, value stocks, and improvement in coronavirus treatments and vaccination. Bear case is, technology is overbought and potentially can, continue its slide towards the 200-day moving average. So that's the bear case. So that's my view on the market. I think we will retest, spiders will retest prior to elections. We'll retest the 360 level, which is in the next months and a half, potentially sooner. So that's the view on the market. How do you trade in current market conditions? Irrelevant what the opinion is on the market, right? The goal of the trading is to have an opinion on the market and then invest based on your belief, right? None of these levels give you 100% certainty, right? Some people think that 50-day moving average will hold on spiders. Some people believe, we will retest 200-day moving average. Ultimately, all these levels have certain probability that we will reach. Obviously, the larger the move of the market, the less probability that the market will reach 310. Probability of reaching 327, I think, is relatively high, maybe 20, maybe 30% probability that next week we'll reach 327. Reaching 310 in the next couple of weeks, it's a low probability event, but nonetheless, they all carry certain probabilities, 20%, 30%, 40%. And also very important that our perception of probability, going back to the traded psychology, is also skewed, right? For someone who's looking at the probabilities of 20% could be the same as probability of 40%, right? So we do have our biases toward the perception of probability. So it's important, no matter what your opinion is, to have a trading plan And the two most important parts of the trading plan, no matter what your opinion is, to help you build in a long-term confidence in yourself as a trader, right? The goal is to have a trading plan and have a long-term confidence in yourself as a trader and be a disciplined trader, right? That's I think is the ultimate goal of any trader who is going through the journey of learning and how to trade, right? You want to have confidence and you want to be a disciplined trader. For me, to be a disciplined trader and to have a long-term confidence, it requires to follow these two important rules. And for everybody is different, right? Depending where you are in a journey as a trader, depending on your portfolio size, depending on your years of experience, depending on your risk tolerance level and your personal trading psychology, your profile as a trader, it'll be different, right? Nobody trades the same way because of these of the background and because of the position size, portfolio size, and years of experience. But everybody should follow the rules in terms of these two main components of trading plan. One is the portfolio allocation. For me, 30%. Usually, I have 30% of the portfolio in cash, and that's the main reason is because that's the average across all the retail investors. Somebody could be 10% in cash, somebody could be 50% in cash, but I think trading on the margin or not having any cash is not the right strategy, right? I think that can get you in trouble, and especially, let's say we do reach 200-day moving average, right? Maybe it's a low probability event, but something can happen, right? Escalation between US and China will go higher, or the unemployment rate might go up instead of going down. All of these things have certain probabilities, and then the market can reach 200-day moving average. So since you never know with 100% certainty which level the market will reach, it's very important to have at least 10, 20, 30% of your portfolio in cash. The second rule is positions, the number of positions and position size. Position size is extremely important, translated into portfolio drawdown. Every time you trade, before you enter a new position, or every time market reaches certain critical levels, like right now we're at 50-day moving average, before you decide whether you should buy at when the market is in correction, or sell when the market is in correction, should be driven by portfolio drawdown. You look at how many positions you have, and then you look at how much money you're allocated per position. So in my case, the goal, if I carry position overnight, whether it's a stock or option position, not to risk less than 2.5% of my portfolio per position. So if I have 10 positions at 2.5% each, that means my portfolio drawdown is 2.5%. Let's say there is a surprise, right? Maybe China will retaliate against United States in terms of putting additional tariffs on technology company, because of the WeChat and the TikTok, issues. And let's say that happens over the weekend, market can really, probably can reach 200-day moving average if there's additional retaliations on major US companies like Starbucks, Nike, and Apple will get affected because a lot of their revenue comes from China and Europe specifically. So those events can trigger additional market correction. So then it's very important, since you don't know if that will happen or not, it's very important to always think about how many positions you have and your maximum loss. For me, I usually have 10 positions, so my maximum portfolio drawdown is 25%. Sometimes, which is aggressive. I think that's aggressive and geared toward more aggressive traders, more experienced traders, people who are familiar with Tradespoon technology and models. If you just start trading, I would encourage you, or you're new to Tradespoon or Yellow Tunnel, I would encourage you to only trade maybe 4 to 5 positions. This way, there is 10 to 50. At any given point, if market does reach 200-day moving average, your maximum exposure is 12 to 15%. And this is something I think is more conservative if you're trading stock or options. And then you can deploy your cash. There are other 85% or 80% of the portfolio that you have. If there is a correction to 200-day moving average, then, or close to that level, then you can start deploying your cash to buy positions, Because as long as you believe we're in a bull market and these are short-term corrections, it could be 10%, it could be 15%, nobody knows for sure. But as you get more opportunities in the market, you start doing dollar cost average and you deploying your cash to enter additional positions. So those two rules are the most important. The next one, trading is based on probability of success. I encourage everybody, whether you're a technical trader or you're fundamental trading, whatever the signals you are using, it's important to think about trading as a bell-shaped distribution curve. Right? Every time you do a trade, Spider is right now at 3. Let's assume it's at 335. I don't even know where we are now, but let's assume it's at 335. Right? There is certain probability that by certain time, let's say by next Friday, market can reach 326, right? Or 325, let's use a round number. So it can move 10% to the downside, it can move 10% to the upside, right? Right now 345 is the major overhead resistance. 342, 345. So as long as we are below 345, so not the most prettiest 345 I've seen, but let's try it again. 345. That's better. All right, 345. All right. So there's a certain probability that this will happen, right? Maybe one standard deviation, right? One sigma move, that 67% of the time, by next Friday, market will either be at between 325 and 345 level, right? And it will gravitate maybe toward 335 as the average price. And if you think it will move, to 320 or 320 or 350, then maybe it's a 2 sigma standard deviation move. So every time you trade, it has a certain probability of success, right? If you're selling out of the money options, or if you're just buying stock, there's a certain probability that the stock will trade in a certain range. So at Tradespoon, we provide 3 different models. We have aggressive power trader, weekly power trader. We have monthly trader. We also trade earnings announcements. So usually these 4 different strategies are being executed in the live trading room environment, which you can get either email or SMS message or participated live. And they all carry probability of success based on our research, 75%. Right, 75% of the time, if you look at the performance of these trades, probability of success is 75%. Right? So these models carry 75% probability, short-term model and long-term model, which is a pretty high probability of success trades, right? So return on capital, usually if it's less than 1 day, it's 1%. If it's 5 days, it could be 2%. And if you carry position maybe a month or longer, it's anywhere from 5 to 10%. Right, Robo investor and monthly trader stock can move 5 to 10%. Right, so having reasonable expectations of probability of success versus return on capital is very important, and having models that are back tested or that are results of actual trading that can tell you what the probability of success and return on capital. And always depend, if you have a smaller portfolio, maybe 1% in 1 day or 2 days is not enough. So always think about that. If you increase your return on capital, right, thinking about the bell-shaped distribution curve, if you're looking for bigger moves in underlying equities or underlying asset classes, then always keep in mind that your probability of success will decrease, right? If you're buying out of the money options, the reason 80% of out of the money or 90% of out of the money options expire worthless is one of the reasons why new traders, to people who are exposed to options, the 9 out of 10 lose money, is for that specific reason, is that usually you're buying out of the money options, you want higher return on capital, but the probability of success that the stock will move beyond what the market makers are already expecting that options to move is small, right? That's why 90% of options expire worthless. So always think about that the more stock has to move, the smaller your probability of success. So you always think about these 2 levers, probability of success and return on capital. And finally, the 4th pillar is to make sure that you have proper position management technique, right? If you're 75% accurate, then you know 3 out of 4, if using model that's 75% accurate, or signal that's 75% accurate, then you have 3 winning trades and 1 losing trade, right? For every time, over a long period of time, now you know you have 3 to 1, 3 winners for 1 losing trade. So managing target gain and stop losses, the entry and exit of these positions, is critical to ensure that over a long period of time your portfolio will grow, right? In example, you know, if 1 losing trade on the options instead of 2.5%, let's say I lose 5%, right? Let the option expire worthless and lose the entire 5% allocation, and the other 3 trades maybe I make 1%, right? Then overall the portfolio will still drop in value, right? If I look for gains of 1%, but I let the stop loss be 5%, then overall my portfolio will go down in value. So that's what helps me to decide, you know, whether I should stay in the trade or not, right? Usually, you know, the goal is never to lose 100% of your option value or not lose, you know, 50% of the value of your stock position. So very important to always have that perspective on trading. Cash, position size, number of positions, probability of success versus return on capital, and position management, stop loss and target gains, to make sure that overall your portfolio will grow. So that's very important in terms of trading plan, and this is my trading plan. The next thing is trading journal, right? I mean, trading plan is relatively easy. I think, you know, 4 main features, pretty straightforward. What takes longer time is building, again, long-term discipline as a trader and confidence, and that takes time and practice. So the most important part is trading journal, right? Trading journal allows me to, and I think is a very effective tool on daily basis before market opens, have pre-market routine. Pre-market routine where you go over your trading plan, and now you're going over your trading journal. You're going over your previous trades, you document all your trades, you go over trades that give you a positive outcome, you go over the trades that give you a negative outcome. And in terms of positive outcome, it all depends again where you are in the journey as a trader and what your psychology is. For somebody like me, you know, maybe a more aggressive trader, it's very hard, and I think this is one of the common issues with the trader. It's very hard to be wrong, right? So let's say, you know, I'm in the middle of the session. You know, we have hundreds of people watching this event. And I basically say, you know, the 330 level will hold, right? And then all of a sudden, over the weekend, you know, China retaliates and the market is at 320, right? So then at least I used to think, and the majority of the thing, people would feel like that, that they are wrong, right? That, you know, they did not predict the market correctly, market trading is against them. And it's very hard to admit to yourself that you are incorrectly predicted the market. And this usually happens if you're concentrating on the outcome, right? If the most important thing for me is to be correct, then I'm concentrating on the outcome and I'm sacrificing the process. You know, I outlined this trading plan, I decided on position size, I decided the number of position, all of a sudden market goes to 320, and you know, I want to prove to myself that I'm not wrong. So then maybe, you know, I carry my stop losses too wide, or I have too many positions, or I buy on the margin. So I start violating the trading plan goals. So it's, you know, for a lot of people, depending on your personalities and depending on, you know, where you are in the journey of trading, this is a very difficult part, is to decide, you know, whether you know, to admit that your prediction was incorrect. So for me, the most important part, what helps me to overcome that, is to concentrate on the process. You know, even if the market goes to 200-day moving average, as long as I follow my 4 rules in the trading plan, then I cut my losses short, right? I execute my stop orders, and I rebalance, right? I rebalance my portfolio and I try to be flexible, right? Even though I'm bullish on the market, but if the market breaks 323 level, right? If we're trading below 320 in the next 2 to 3 weeks, then I would change my opinion. Instead of being bullish on the market and have a delta positive portfolio, I would be more market neutral. I would say that 360 top is here to stay, through the end of the year, and we are trading in a range, maybe between 300 and 360, right? So there now, instead of having portfolio delta positive, I would have portfolio delta neutral. I would have, I would execute more butterflies, more condors, more market neutral strategies. So it's important to be flexible and to be self-aware and to be honest with yourself when you document in the trading, your trading decisions in your trading journal. So for me, it's very important to concentrate on the process. I have well-defined rules, and every time I trade, I would grade myself in the trading journal. So if I'm following the process, I'm following my steps that I outline in the trading plan, and I have either positive or negative outcome, I would give myself A or B. If being correct is more important to me, and I'm violating these rules, then I am would grade myself C and D. And the goal is to have less C's and D's. 95% of the time being A's and B's, where I don't, I keep number of positions the same, whether it's 5 positions, whatever, if I decided, or if it's 10 positions, the number of positions is always the same. So the trade size is always the same. Maybe when volatility spikes, you decrease your trade size, but you're following your trading plan. So process versus outcome is very important. Yellow Tunnel is a sister company of Tradespoon. I encourage you to open up an account, especially when volatility rises, right? When volatility rises, we tend to make decisions based on our biases. And this is the reason for Yellow Tunnel. I created a Yellow Tunnel, and we have Dr. Maneker, who joins us for the webinars and for the blog to provide you with the content on how to handle the uncertainty, right? There has been a lot of uncertainty this year. Obviously, with the COVID-19, the uncertainty continues to be elevated, definitely above historical averages. So you need to, trading psychology becomes extremely important. So I encourage you to review the webinars and the blog that can help you maybe have new ideas or new revelations about yourself as a trader, as a person, and how to deal with these outcomes. For me, in terms of trading psychology, kind of on one side, it's being correct is very important. On the other side is this fear of future regret. The way I overcome the, whether I want to be correct or not, is fear of future regret. Because if I do trade, if I have too many positions, let's say at this level, because I think 330 will hold, so I'm gonna, deploy all my cash, let's say, and buy, have zero cash, just buy as much stock, as many stocks as I can, because I think we will retest 360, right? I mean, it's 10% move. It's a pretty significant move. Then I always go through this what if scenario. What if I'm wrong, right? What if market does drop to 320 level or even the 310 level and I don't have cash anymore, right? So I have this fear. This is the term that Dr. Maneker coined, fear of future regret, right? If market is at 310 level or 320 level, right, and beyond what I expected, and I have zero cash, or I bought on a margin, or I have too many positions, to me, that's a stronger feeling, stronger emotion than fear of missing out and buying, the stock because it's a 332, right? So you pull between these two forces, fear of missing out, right? 10% move. I mean, that's a significant move. A lot of people are, buying stocks on the margin right now, versus fear of future regret that if I'm wrong and I deviated from my trading plan and the market drops to 310, all of a sudden I don't have any cash, or I get on a margin call and I have to liquidate my position. So the fear of that event prevents me from over trading my account or increasing my position size. So trading psychology is important, especially when VIX is elevated. we're, market, it's still low, 26, but it's been as high as 40 last week. So, if we do have a washout next week, potentially VIX can be at 40 level again, or even 45. So trading psychology is important. We talked trading plans important, trading journal is important. The pre-market routine before market opens, going through your trading plan, trading journal, these future rehearsal exercises where you imagine certain scenario and do this what if scenario, and you imagine yourself market at certain price points. Look at your portfolio into the future, right? Imagine market is at 325, what your portfolio will look like, and be honest with yourself, how will you feel, right? What are your main feelings that you will experience if the market is at 325? And then go through a scenario if the market is at 360, right? What are your feelings? What does your portfolio look like? And I think that should be a part of the pre-market routine to help you decide on the number of positions and the position size. So then how do you trade? So trading psychology is great and wonderful, but ultimately, at least Tradespoon was built on the financial models and financial modeling. We have a team of financial engineers. So we have we have 3 different services. We have portfolio, and if you guys have any questions, let me know. What is the blue range? Not sure if it's blue or green, but these are Bollinger Bands. So Bollinger Bands, middle line 50-day moving average, and upper and lower lines are 2 standard deviation moves. Right, so for spiders, 2 standard deviation moves based on the daily chart is 314 and 354. All right, so for Tradespoon, a lot of subscribers want to have access to the live portfolio. And every time I trade, know what I'm trading. So we do have Elite Circle, right? So you can always go to Elite Circle and click for today to see all of the trades for today. I sold COF, right? Capital One Financial for 35 cents, trading at 10 cents. And this is part of the active trader, right? So these are short-term trades, part of the active trader. So you can see today we have GPN, ITW, and Triple M. COF is actually came from the aggressive power trader. But the idea is that we provide signals on active trader or aggressive power trader, that's yellow tunnel. Yellow tunnel service, aggressive power trader gives you more symbols that I'm trading. And this is what I'm trading in the Elite Circle, right? So you can go in today, you can look at the last 7 days. What are the trades? You can look at the, hedges. Let's say, what are my positions in spiders? So it shows you that, I sold 355, 365 call spread for $3.54, trying to buy it back at $1.50. So Elite Circle gives you abilities to have real-time access to my portfolio. This is synchronized with, this is not something I enter manually, this is synchronized with my brokerage account real-time, along with SMS message. So you will get an SMS message every time I trade these models, which are active trader, monthly trader, and weekly trader, or aggressive power trader, aggressive weekly power trader on the yellow tunnel side. So that's yellow tunnel, so that's Elite Trading Circle. You also have morning bell and closing bell, which you can participate live in the live trading room environment. We have 5 days a week, first hour and last hour of the trading. There's always either IR Scott, moderating the live trading room environment. You can actually see why we get into these trades, why we close in those trades. You can find the commentary. In terms of hedges. So that's Elite Trading Circle. Pretty aggressive. Every day there are trades. So this is if for somebody who is trading basically on a daily basis. If you're trading less often, maybe once a week or a couple times a week, we do have two more different services. We have premium portfolio. This is where I trade option spreads. The signal gets generated on weekend. The model runs and makes predictions, 4 independent predictions for all of the optionable stocks. So Home Depot, the model ran and basically made predictions for the next 20, 30, 40, and 50 days. 4 of 4 predictions are higher. So you can look at the accuracy, 80% accuracy that Home Depot between the Sunday when the model ran and the next 50 days, the trend is higher and the stock will continue to go higher on average price. So because of that information, I'm buying a spread in my personal account, 265 to 70 call spread for $3.10. If you're not comfortable trading option spreads, then you can just buy a stock or an option, right? So you also have an instructional video that is part of your that's part of the service that explains you my view on the market and why I entered the trade. So that's along with all the open positions, you get SMS message every time I enter or exit the position or adjust the position, and access to all the open positions. So again, this is optionable. This is both stock and options. Once a week, you get a signal. The difference in the premium portfolio, I always trade option spreads in my account, right? This is what I trade. So not only do I have to be correct on the direction, the model has to be correct on direction of the market. Also, the model has to be correct on the timing, right? Because I'm trading options. By November, Home Depot has to trade higher, the average price, and the spread needs to go up in value. If you're not comfortable trading option spreads, we also have a Robo investor portfolio. Robo investor portfolio, similar fashion, there's 4 new trade ideas a month. They're being published every other week. You get a newsletter with the new 2 trades and why we got into the trade. So again, you can see the entire portfolio, you can see orders, all the positions. You can get SMS message every time I would get in or get out of the trade. You would also get an SMS message, as long as other tools. So this is a Robo investor portfolio. On average, I have 20 positions, right? 20 to 25 positions, allocation anywhere from 2.5% to 5%, and goal is 10% gain, 10% stop loss. And you can see all of the trades in Robo investor performance. And again, since it's a stock portfolio, then I have more time to be correct, right? I can hold this position longer than if you compare to the options trades. So if you're more comfortable trading stocks, then this is the portfolio that we have. So this is access to live portfolio, Robo Investor, Elite Circle, and Premium. The 3 different portfolios that we are managing in Tradespoon. Joseph, Alex, good morning. Where would Apple find support? Well, Apple continues to break down as we talk. Spiders is at 332. Apple is making new lows, and that's one of the, I would keep an eye on Apple. I would keep an eye on Microsoft, making new lows, and I would keep an eye on Amazon, right? That's where the correction is coming. This is where the new lows are being established. So for Apple, well, the first support is 109, 50-day moving average. This is the most obvious. The longer we trade below 50-day moving average, Apple, the more likely it will retest, either before the earnings announcement, which is 95, or the gap after the earnings, which is 100. I think the market is going to be in correction, well, obviously today and probably next week, right? There are holidays. And lack of, the volume, I think, usually volume next week will go down and volatility picks up. So I think the next 5 days, it's reasonable to assume that it can reach 100 or 95. But again, nobody knows for sure, right? It depends on the next week. So Apple is definitely overbought, oversold. I don't think this is the end of the bull market for technology. I still think that this is just a temporary 10-15% correction, rotation to the value stocks. I would, maybe not wait for the, wait for maybe to clear 112 level before you start thinking of entering Apple position. But at this point, I think there is more room to the upside than to the downside, right? Maybe to the downside. That's another way to think about it. Even if, let's say, it reaches 95, that's 12 points to the downside, but to the upside, I think it can go 30 points, right? I don't think this is I think this level will be, before the elections, will probably reach that level or after the election. So if you have a long-term perspective and you use dollar cost average, and it's very hard to time the stock exactly where it's going to stop, then this is where you look at risk versus reward, and I think there is more reward than there is risk in Apple right now. Good morning, Alex. GPN was a good trade. Let's see. Yep, thank you. And this is a perfect example of, again, rotation to the values. Netdeck is down 1%, Spiders is down 1%, but the active trader and the aggressive power trader, these are the 7 symbols, they're all up. Not all, but outside of United Airlines, 6 of them are actually outperforming both technology and Spiders. And that's what you want the model to do, is to find signals that will actually, will outperform the market, which is, I think, is important, right? So this is where I actually traded ConocoPhillips, Global Payment Network is what Alex traded, but the fact that, they're more green than red on these signals, that speaks highly of the validity of these models. Alex, thank you. US dollar, Canada, Koshik. I mean, my personal opinion on dollar is that it's going to continue going down. And my opinion on Canadian economy, it's driven by predominantly commodities, right? Gold, oil. So where's FX? I haven't looked at Canada. Let's see. FX. What's the ETF for Canada? FX, EWC. So it's following the emerging market, probably a little bit underperformance. So, I think Canadian dollar will go higher. I mean, in terms of currency pair, I think FX. Right, this is Canadian dollar, right? That's correct. So I think this trend will continue. Right, stronger Canadian economy, weaker US dollar, higher commodity prices, and that's being reflected in the crude prices. Right, crude oil continues to go higher. We had a short-term correction to the 37 level, but we're, despite market correction, crude oil is going higher. If the crude prices are going higher, if the steel prices are going higher, that's meaning that more and more market participants believe in V-shaped recovery. All right, toolbox a bit. Okay, so the question was, how do you explain the toolbox? So let's look at GPN, right? Alex traded GPN. The model runs on the 8 p.m. Central. So 8 p.m. Central model runs and makes predictions about the market, right? So it ran last night at 8 p.m. and it uses for 10-day predictions and uses each data point that is being fed into the model. Model is trained on the data and does the tests and makes prediction. It's neural networks. So made a prediction that today the market will trade between 328 and 336. That means that at 8 p.m. we already made a prediction. Model made the prediction that if the spiders today reach 336 level, which that's where it opened, the stock market is overbought, right? So the idea is that if you see market reaches 335 at 9 o'clock in the morning, or it opens, the first 15 minutes and you're at 336, based on the model, you should short the market at 336 if you're an aggressive short-term trader, right? Until the market breaks through the 336 level, right? The obvious overhead resistance right now is 342, right? As long as the market is below 342 level, bears are in control, right? For the bulls to resume the upward momentum, the market has to trade above 342 level. And that's being reflected in the model. Model basically says the trend is negative, the range trade, this is the vector for the next 10 days, is negative. The momentum behind the bears is, the trend for today is also more or less neutral, down 0.5%, but still neutral because market is oversold. Any positive news and the market should bounce back. But the 10-day trend is to the downside. So at 336 you should go short. At 328 you should go long. And you look at the vectors, half of them are red, half of them are green. That usually, if all of them are red, that means it's a downward momentum. If you see some red and you see some green, that means market, trading in consolidation range, it's building the bottom, and we're getting close to that bottom when you look at the 10-day range, right? Yeah, I can break down to 328, 326 level, but this is, range-bound trading and the beginning of the bottoming process. So Active Trader is based on the stock forecast toolbox. It's also based on other models that we use. So GPM, where we get these numbers, 171 and 99 and 181, 48, they are coming from stock forecast toolbox, right? We have model that runs at 8 p.m. It basically says which stocks will outperform the market, right? So global payments is one of them. The idea is that global payments will outperform the market, and ideally you want to buy at 171.99 or sell it at 181.48. So you look at GPM today. It rallied in the morning. Usually we wait 15 minutes. It dropped to 181 level. An Active Trader basically says you have two strategies, right? If you see pre-market down, if you see futures are down more than 0.5%, then wait for the predicted low. Predicted low did not happen today. Value is outperforming the technology. Value is outperforming the growth, but value stocks like GPN is an uptrend. So you give you two choices. You can follow strategy A if you see the S&P futures are down more than 0.5%, which they were not, at least prior to market open. Then the second suggested price is use previous close price, right? Use the previous close price, 181.48. So when it reached 181.48, almost to the penny, right? Then I assume that's why Alex bought the stock. So you buy it 181.48, and then it jumped. At least right now it's 182.96, despite market correction. So credit cards continues to outperform in the up direction, and that's how you would interpret this information. In the live trading room, when I trade, again, I have two entry points, either previous close price, right? Or I wait for the predicted low or previous low. So those are the three trigger points to enter the position. Obviously not, sometimes, especially if the market gaps, then the entry point will never be reached, right? Sometimes there is a gap and 180, 148 is never reached. So then, you have to make your own decision whether you want to enter at 180, 148 or you do not. So thank you for that question. And the model also gives you a grade, right? Right now, model grade is A, meaning that 90% of the time, well, in this case, 81% of the time, if the model predicts the low and high, then the stock is trading in that range, right? For spiders, model grade is also A. So 80% of the time, if the model predicted that 328 is a support in 336, then by the end of the day, market will close in this range. It's 80% of the time. So that gives you a confidence level, that meaning that as market approaches 328, consider going long if you're aggressive short-term trader, and every time market approaches 336, consider going short. And but that doesn't mean that if stock is, if stock is down, right, is Fortinet, is grade B, then it shows you that model is less accurate in terms of finding the range. But still, if Fortinet is at 115 and the prediction price is 114, you still should consider that the Fortinet is oversold, and if you're an aggressive trader, potentially enter the stock at 114. It's just model grade B means, just like student A and student B. It doesn't mean student B is a bad student. It's just less accurate, less often correct in terms of the range. It's correct that it's, this is oversold, but it's also less often correct that the stock will close in between that range. So 78% of the time in this case. All right, any other questions? It's 10:25. All right, that's all I have for today. Have a great weekend. If you guys don't have any other questions, if you celebrate New Year, for Jewish holiday, happy Rosh Hashanah. If not, have a great weekend, spend time with friends and family, and I hope to see everybody the closing bell today or Monday. Thank you very much and have a great weekend.